All right, hello. I'm Zach Howard, and something a little bit different for you guys here tonight. After dark special, I guess you want to call it that. I've been doing these videos for a while now. Started about a year ago, kind of not really taking it serious, and now I'm almost up to my goal here of 500 subscribers. So I really appreciate that, and try to do these videos consistently now, getting up that 100 magic number, round numbers, videos. I don't know where this is going. I kind of enjoyed it. It actually helps my process. If you guys are getting something out of it, even better. But I kind of want to today, as a thank you, say this is kind of how I became better at this game, which is markets, which is the greatest game ever. I love it. It gives you an opportunity to play against yourself, nobody else, every single day. It's hard. It's critical thinking. It's strategy. It's data. Everything that gets me excited. And I've been doing it since probably I was a teenager. But really, over the last 7, 10 years, really kind of refined the process to get better than bad at something. Not saying I got all the answers by any means. Make mistakes every single day gives me opportunity to kind of get better at it, and that's why I love it. But I did this presentation basically on how I come at markets, how I come at trading and portfolio management, and some of the influences in that strategy that I have. A lot of it comes back to teachings from probably the godfather of markets, Benoit Mandelbrot, and his work around fractal patterns. As you can see, fractal patterns in true nature. Nature is not fake. It can't be manipulated like human beings and markets can. That's why if we want to find truth, signal nature, whether it's leaves and trees or how waves come in out of the ocean, forests, all that kind of stuff gives us clearer thinking about how price moves. So that's where Mandelbrot comes in. Hedge eyes, macro processing, and how they look at data from a growth inflation policy standpoint, and really the rate of change of something. Is it staying the same, getting better, or getting worse from its rate of change? Kind of ties back to the seasons, whether you're looking at spring, summer, fall, winter, and similarly to markets. What is the rate of change of the pattern in terms of positive or negatives? And looking at those kind of characteristics to guide us, drive us to where markets could go at certain asset classes. So that's really my bedrock. There's a lot of other influences over the years. I come from traditional finance background, Benjamin Graham, analyzing financial statements, debt to equity, all that traditional working at a commercial bank, which actually is a hindrance, is Achilles heel, trying to understand the new game and the new machine that is markets, which none of that old stuff really matters at all, especially if you want to get better than bad at it. It's not about narratives, not about talking points. It's about thematic investing sometimes. For instance, very bullish on Bitcoin right now in the future, what that means, but how Bitcoin then lines up in terms of other asset classes like a commodity versus a currency. And the volatility components of these trades, which is a major fundamental part of the process as well. How I look at it, my timing on trades are not the same. I got young kids and who don't need the money till their education comes later on in life. So how I manage their investment account versus my day-to-day trading will be kind of different from a time duration standpoint of certain trades. I like core themes in week to week, and then inside of that, quarter to quarter, that fit inside a longer term tail is the methodology that Hedge likes to use. Tail being less than 3 years, trend being less than 3 months, and trade being less than 3 weeks. So trading inside of all those narrative bands inside a bigger trade backdrop. Um, Before we really get into the meat and potatoes of the system and how it really works for me, so another book that I think is probably worthwhile having as it relates back to market's nature, fractal patterns. It's an easy read and also really resonates with me because I heard money, Austrian type economy thinking, Roy Sabag's book, The Natural Order of Money, which really also goes hand in hand with principles around gold, uh, scarcity, proof of work, which then ties into the new age gold, Bitcoin. So those those three kind of parameters are how guide my philosophy about markets investing. The Hedgeye process, the Mandelbrot process, and then the Austrian economics hard asset type principles. That's what we're looking at there. Fractal patterns, like I say, look at volatility. I look at the interrelationships of different asset class. If currencies move, how does that then move with relation to bond yields? And then how does that move in terms of commodities? And when you see similar sets across different patterns over time, you're able to recognize potentially where the probability of the puck is where it's going to go. This is more of a science than a game. And back to like Mandelbrot's principles there. And once you realize that you have an edge, it's just like you're playing a blackjack and you know certain card patterns is when you should increase your bets. You have a jack and the dealer's showing a six, you have opportunity to double down. You take that opportunity. Doesn't mean you're going to be right every single hand, but over time you pay 100 hands, you're probably going to win 60% of the hands, and more importantly, it's what you bet on those 60% that makes a difference. And that's the same thing with markets. When you really understand, you think understand the flow and where the pattern is, and you have a good conviction on a trade, that's when you size it up and you really make a difference on the profitability, because you're going to have losses. I probably take somewhere around 30 to 40% losses over time. But then the ones I really end up doing well on over time is if I size the losses smaller than I size the winners, obviously. So back to Hedgeye's process kind of guides me like to do a 4-quadrant model. And basically over here you kind of see where the growth, inflation, the policy standpoint takes you. Currently, like here, ending up Q2, end of June, we're in this quad 2 environment where growth and inflation are accelerating from a rate of change standpoint. Doesn't mean we're having like 5-6% GDP. It means if we were at 2.5% GDP year over year, now we're at 2.9, 3.1. That's a rate of change enough to say this is the probability that we're in this type of macro regime. Potentially we go into a quad 3 environment here in Q3 for a short spell before we have a continued growth and inflation environment. When you look at the backdrop of what this whole fiat monetary system is, it's based on a continued pushing of the accelerator of that debasement and thus creation of money supply. By any means necessary, fiscal deficit spending through the government, debt refinancing throughout the financial industry because of low rates. The factors that had to continue to stimulate, we're going to get inflation on a long-term journey of all this in depths of disinflation type month to month, quarter to quarter potentially, but on a longer term duration, we're in this quad 3, quad 4 environment that's really a good setting, back testing for stuff like hard assets, gold, Bitcoin, those type of higher beta plays. If you're in the quad 3 environment with a stagflation where you're having slowing growth, but inflation is accelerating faster than the growth, and that's really the game of this fiat system, if you ask me. Like I say, I talked about the duration of the trades: 3 weeks, 3 months, 3 years, and then inside of that, and like another core thing I do is I keep a daily notebook and I track all these certain trades, whether they're currencies, bond yields, volatility readings, commodities, mega cap equities, and the indexes, and how they form patterns, how they line up with other different trades that give us more of a probability picture of where stuff's going. Like it's not a X or O, is one or the other. You had to carve out like a chess game over time and really develop different things. And that's where not just the number side, but like I keep like a daily journal that kind of lines up with stuff I'm hearing, seeing, can relate back to. And if I record it myself, I find I retain it better, which is like these videos. Like I'm doing it more for myself to try to get proof of work. I'm putting the content out there in front of a microphone and camera, which is not always easy, but it's helping me kind of communicate better myself. I can get it out there in the public. Talked about Mandelbrot, his influences. Talked about kind of how I came at stuff. Another great book is this one here, an engine, not a camera. Has a lot of good old school market stuff in here. Is an underrated finance book. A lot of people, I'm sure, read it. I can't remember where I came across it years ago on a podcast. And of course, Talib and his principles fit in there a lot too, with fool by randomness and some of his modeling around tail risk, those kind of longer term, high risk, low probability outcomes that don't happen very often. But when they do, they can be very dangerous to a portfolio. I have my bullish hat on, my bull hat. I'm super bullish on humanity in terms of society and where everything is going with technology. I'm not a doomer. I'm not like, oh, WW3 is starting tomorrow because of this tweet. Like, that is only in the cause you grief in your head and your portfolios. It is really it's not a positive environment to try to build alpha, if you ask me. Um, Optimism is mandatory in this game. A great quote, and like it speaks highly to what you're trying to do on the longer term standpoint. So you can still be cautious, still have risk management, but in the long and broad out process of this fiat game, remember the rules of the game. You have to be bullish because that is the only way this game continues to go on. They cannot have the game end. So we are going to continue to be bullish in the longer term with short durations of risk off and risk management along the way. Talked about how I look at something if it's a bullish or bearish trend. If something is in a long term bullish trend, for instance, like Bitcoin is right now, and its current trade is back and forth between neutral and bullish, but the range of that trade is say 110,000 on the high end, 100,000 on the low end. You see Bitcoin pull back to 100,000. That's where you kind of want to press. Is that same example of having a jack where the dealer has a six? You're using that kind of probability that Bitcoin has a higher up than down in the shorter term, so you can trade around that. In the larger backdrop, or you want to have a core position in Bitcoin or gold or whatever it is you're trading. Um, so I always maintain like a minimum long-term holding in certain trades. I'll just trade around it. So if I get to like 10% and I want to scale it back to 5% because I'm saying potential macro regime is coming, which is not going to be bullish for this trade, I'll adjust accordingly. And that's just how I like to do it. I like to play in the game straight up every day, every week. And I've been doing it for years like that. Some people are ghost me and they just buy stuff, put it on, and forget about it, and they do a lot better. And you hit sometimes if they pick the right work before they go put the trade on, that can be a better strategy depending on you as a person. So back to the quadrant model there from Hedgewise, like you say, you got your quad 2, which is the sweet spot, and quad 3, a little bit more conducive to, you had to be more alpha picking in your strategy. You get the VIX down around 13, 12 in a quad 2 environment. You can buy Fartcoin and ABC car racing in 2030 on the moon incorporated, and you will be all right. Where shit hits the fan is over here in this quad 4 environment, like we had back in April, Liberation Day, and it doesn't matter what your long-term theme on a commodity is or a trade. In that environment, you better know your risk management strategies, especially when you get volatility in the VIX up around 30, 35. It's hard to make stuff work unless you're very constructive to the trades in that deflationary, disinflation environment, slowing growth. Statistical outliners, that's kind of where the volatility comes into, understanding that over time you see it clustering like we've seen in August 2024 for a short spell, and now here most recently Liberation Day in April. But looking back on it now, it's easy to say when we seen that VIX spike to the high in the 40s, we should have been pushing on risk trades, but our emotional intelligence plays with us, and we're like, man, this is going to be another 2008, another 2020. Like, oh my God, is the VIX going to go to 70 and America going to keep falling? But let's reverse it back and understand the rules of the game. That little bit of pain on markets, especially with bond markets selling out, forced the central planners, whether you're central bank or a Treasury Secretary of the U.S., to get out and try to say, calm down, markets. We will come and help you if this gets any worse. And that's what we've seen with Scott Bessent. So a lesson to be learned from these volatility cluster time to time events, that's when we really want to get out there and press the beta, have liquidity available, and go for the juggle around those trades because we know it's not sustainable for volatility to last in them environments in the US financial markets. So this is, like I say, my suggestions. So you can try what works for you. It took me a long time to get what worked for me. I'm still working on it, but I like the strategy. I like these higher beta environments that provide this opportunity backdrop to like to hone in on some of this work. Take a notebook, track different trades, use like color patterns with your notebook in terms of different commodities, different currencies, bonds, financial markets, etc. And then take a notebook for your daily color, what you're seeing in price action as it relates to those type of movements in signal. I would turn off all mainstream financial media at all means. I would look just at the data, and it's a lot more simplistic, clearer way to go about markets. Spend that time outside with your family, looking at the ocean, woods, or something like that instead of turn on financial TV. If you like this content, I would really appreciate a subscribe and maybe just a comment or like, and I'll come back again with some more greater content like this that I hope is educational and entertainment. Definitely not investment advice. Check you out later, guys.